Welcome to Wednesday at the 2016 Milken Institute Global Conference. We saved the best for last here at the Milken Institute, so I'm very happy to have to be able to moderate an extremely timely and relevant topic, Treasury's war on terror. And let me start by introducing my esteemed panelists. To my far right, we have Timothy Adams, who is President and CEO of the Institute for International Finance. And for the two people in the room that don't know what that is, it is an association of 500 financial services firms from, I think, over 80 countries. Tim is, of course, the former Undersecretary of International for the Treasury Department. To my immediate right is Christine Duhane, who is the founder of Digital Finance Institute and has a long history working on AML, regulatory and legal issues. To my immediate, my left is John Dye, who's the Executive Vice President and General Counsel and Secretary for Western Union, and everybody knows what Western Union is. Next to him, Matt Epstein, who is the CEO of the Campstall Group. And the Campstall Group is an advisory firm that advises governments and companies on illicit finance and sanctions policy. He was previously the financial attaché to the UAE, where he ran and coordinated sanctions and economic policy for the Treasury Department for the region. And last but certainly not least, Farley Mesko, who is CEO and co-founder of Sayari Analytics, which is a company that is going to solve all of these problems for us, we hope. So the idea of this panel is going to be that we spend the first 30 minutes or so whining about the problem from the various different perspectives, and then we'll spend the next 30 minutes or so thinking about solutions, because this is a very intractable problem. And one of the things that makes it intractable is that every actor in it is acting rationally. And so when every actor is acting rationally, it's very hard to kind of get yourself out of the morass that you find yourself in. So we want to make sure that we devote enough time to that. But first, Matt, how did we get here in the first place? What was the new thinking about for using the banking system for AML-CFT?
Sure. Well, after 9/11, the U.S. Put significant focus on disrupting financial flows that were benefiting terrorist organizations such as Al-Qaeda and its affiliates through sanctions programs. And the cornerstone of the sanction program was Executive Order 13224, which prohibited U.S. persons from providing material support to designated terrorist groups. Under this program, the US Treasury would publish lists and continues to publish lists of individuals and entities that were found to be supporting terrorist organizations. And these programs were modeled after counter-narcotics efforts in the 1990s. In 2005 and 2006, an additional threat became very significant. The Bush administration was very focused on Iran's nuclear program, and again turned to sanctions policy, sanctions programs as a means to coerce Iran to dial back its nuclear ambitions. At the time, the U.S. direct economic leverage over Iran was deemed to be limited, and so developing international support and cooperation for Iran sanctions was key. These programs were really defined as conduct-based targeted financial measures and involved highlighting Iranian support for terrorist activity, for missile proliferation and nuclear activities, and then educating the private sector through direct meetings with bank CEOs and encouraging them to think very carefully about their compliance programs as dealt with Iran and Iran business. In 2007, at the same time, the U.S. was confronting North Korea and its nuclear program. And as part of those efforts, the U.S. Blacklisted under Section 311 of the Patriot Act a bank in Macau as a primary money laundering concern. And this action had significant impact, not just on the financial institution in Macau, but on the North Korean government and its ability to access international banking services, foreign currency services. And that drew a lot of attention to the effectiveness of sanctions programs and sanctions policy in terms of advancing and addressing national security threats. In the Obama administration, Congress took an increasingly active role in driving sanctions policy and started pressing on the administration and advancing legislation that would encourage a very significant, the significant use of pressure for these national security threats. And at the same time, the Department of Justice and the New York Department of Financial Services began levying fines against banks denominated in the hundreds of millions and the billions of dollars for violating U.S. sanctions policy and anti-money laundering regulations. The one thing I would point out there is that the central role of the U.S. dollar in mediating global commerce and financial transactions gives enormous leverage to U.S. sanctions and anti-money laundering policy. A payment from a Sudanese contractor to a Japanese heavy equipment manufacturer will transit through New York. A direct deposit of a salary remittance from a Cyprus-based shipping company to a bank account in Crimea will transit through New York. A remittance from an exchange house based in the UAE to a family in Pakistan will transit through New York. And so financial activity that otherwise has no nexus to the U.S. Through these correspondent banking flows ends up touching institutions which are required to uphold U.S. sanctions laws and anti-money laundering regulations.
That policy reminds me very much of the policy that my father advised me to pursue when I was graduating from college: follow the money. Tim, you were Undersecretary of Treasury for International at the time.
Money, money, right?
Yeah.
Yeah.
How was that working for you at the time?
Well, I was at Treasury at 9/11 and witnessed and was a part of putting together the apparatus that Matt did a very good job of describing. And we went from literally zero because we didn't understand where the money was going. We didn't know how to follow it, the rudimentary techniques for understanding the flows. But to Treasury's credit and other parts of the U.S. government over the past 15 years, there has been a very robust effort and infrastructure put in place to follow the money, and I think it's quite good, actually. So kudos to Matt, who's been out on the front lines, and others who at Treasury and other institutions in the U.S. government and globally who've done a remarkable job. But it is a useful and it is a powerful tool, and one in which if you're sitting in the Situation Room of the White House and you're looking, and the president's thinking about a variety of different tools to employ to bring about some change in behavior policy, it's an easy one to go to. It's not without cost, but I think in many instances it's proved to be quite successful.
How's it working for you, John?
Well, it's very interesting to hear both of these comments because at Western Union in 2001 we had about 6 compliance people. And I started there about 5 years ago and really committed to increasing the compliance effort. We now have 2,200 compliance personnel. I alone am the 8th largest employer in Colorado, which doesn't get me anything, doesn't get me free Rockies tickets. But I do have a budget of it's about 3.5% of the revenue of the company, which is pretty substantial. So we have built up a huge compliance effort, recognizing, of course, the need for that. I think one of the interesting aspects of the AML regime is the sort of layering that has occurred over the course of 15 years. While I think the intentions are good and everything has developed in a very effective way, it's sort of regulation on top of regulation on top of regulation. And I think it's time to start to rethink how this space gets regulated, because at some levels it's very effective, but at other levels it's creating some unintended consequences which I think really need to be addressed. And one of those is de-risking. Right now, banks are going through a process of de-risking many people in our industry, both our agents, we primarily rely on an agent network, and also companies themselves. And I understand why they're doing it. They see that there's an asymmetry between the risk and the return. But this is a very important policy issue, because in my industry, the remittance industry, we serve a very fundamental need for people, particularly who are unbanked and underbanked. We are part of the solution for financial inclusion for people who don't have access to bank accounts. But the AML regime and the enforcement of the AML regime has created this asymmetrical risk for the banks that makes them now just completely discount wholesale entire industries without regard to whether a particular company has a superior AML compliance program and whether they execute on that program. So there are some unintended consequences which I think are coming forward now that we really need to start thinking about and thinking about how we can address.
So de-risking, if you use a risk-based approach whereby you refuse to bank the actors that you consider most risky on an individual basis, that's a risk-based approach. De-risking is the wholesale refusing to bank a sector or a country or a type of entity because it's just too difficult to bother with them. So that's the issue that we're discussing. And Tim, I'm going to go back to you before going to our last two panelists, just to put your new hat on as a representative of the banking industry. And just, can you talk a little bit about the calculus that banks are making there and how they are, and what, yeah.
Right, no, it's, the point is spot on. There is massive sweeping de-risking going on. Part of it is part of a larger process that a reversal of 3 decades of financial globalization. And it's happening for a host of reasons. Just pick up the newspaper every day and you see GSIBs, big global banks pulling out of markets, continents even. And so it's part of a broader story. But there is a sense that in boardrooms, that no one wants to be subject to the kinds of scrutiny or fines, either by dollar amount or reputational risk that we've witnessed over the past 6 or 7 years, if not longer. And so there is this sense that they need to pull out of markets. And while FATF and other standard-setting organizations say, we're going to offer you clarification, we're going to have better definitions. And as one CEO told me in London last week, I don't care what FATF says, as long as the Department of Justice treats this process with zero tolerance, we're pulling out of markets. And so it's happening. And what I've seen the debate, it's an interesting shift in just 12 months. I went around to see standard setters a year ago and said, we really need some help, we need some clarity. And so I got a lot of pushback, which is, you banks, it's a low margin business, you're using excuses to get out of markets. And so banks said, fine, we'll do something else. And now we're seeing the public sector come back and say, oh, we'll give you clarification, please don't go, for a whole host of really great reasons. Financial inclusion is incredibly important. We need the circulatory system to continue to work to get the unbanked into banking accounts. But there's just been this massive movement among institutions, which is we're going to leave it and we're going to leave it alone and we're going to focus on other lines of business. And I think the real debate now is within governments, within standard setters, within policymakers, which is how do they create a regime that gives some comfort to institutions. I don't think there's an easy solution to that in the near term. I think this is going to be a long time coming to get institutions back into this business, if they ever get back into business.
The one thing I actually want to add to that, financial inclusion is obviously a hugely important topic, but also transparency and money flowing through the formal system, because the one immutable truth is the money will always flow. Whether it goes through legitimate means, like banks or our organization or other money remitters, or it goes through Hawala, bulk transfer of cash, other means which go under the table. They don't allow law enforcement and other agencies to see that money, and quite frankly, they don't give the consumers the protections they have if they operate through legitimate means.
You're right. This is a reconfiguration of the financial circulatory system. Yeah. And you have a lot of other institutions that may be not quite as transparent or up to the standards of some of the large institutions who are filling that space, and there are real implications for that.
Yes.
And I do want to...
I could just address that one quickly. It's a constant tension in the government, the issue of, do you want to see the flows or do you want to stop the flows? Right. And so certainly it's important to see the flows, but why? Is it important to see them so you can stop them? What is the ultimate outcome here? One perspective is that putting in place these regulations, it serves as a tax, not just a tax on the institutions that have to apply these regulations and so forth, but a tax on the organizations that are engaged in the illicit conduct. So how high can we raise the tax on these organizations, drug traffickers, terrorist financiers, proliferators, and so forth, so that they're spending more of their time and more of their resources figuring out how can I raise and move money versus how can I accomplish the illicit goals at hand?
As moderator, I'm going to insist that Christine and Farley also get a chance to talk. So, Christine, tell me about, from your perspective, and you work both, you're an interesting panelist because you work both on AML issues, but you also work on financial inclusion issues. So,
really interesting points that were raised. And so I think from the FATF perspective on the policy, you know, the recommendations were intended to be risk-based, and they were intended to make sure that we look at a situation and we take an assessment of whether or not a person is bankable or not, and whether or not we want to have a relationship with them. But we have actually wholesale de-risked and decided that populations or, you know, Bitcoin businesses or whatever it happens to be, crowdfunding companies. So we've created this situation where we're kicking people out of the banking system because we've decided as a group they're too risky to have as clients. And the kind of interesting question it raises is really, is a bank account in today's world really a contractual thing where a person has a right to have a bank account? Or like in our country, in Canada, we've decided that it is purely contractual and you don't have a right to have a bank account. But in 2016, I think that that's wrong. I think that you do actually have a right to have a bank account because you can't survive without one. You can't get a payment from your employer. You can't rent an apartment. You really can't do much without a bank account. So if we kind of step back a bit and say, well, let's change the dialogue. Don't we all have a right to a bank account, and don't we all have a right to financial services? Because if we don't take that perspective, we're actually creating a lot of global poverty by the financial inclusion issue. So I think taking a step back for us, it's really important to have the dialogue on financial inclusion and with AML, because AML, whether we like it or not, has caused financial inclusion problems. And so I think as a financial community, we have an obligation to say, okay, well, how can we balance those two? How can we have that dialogue and make sure that we're not creating poverty, we're not creating an unbanked situation, we're allowing people into the financial system and into getting jobs and apartments and what they need to survive in today's world.
and I would even make that point at the sovereign level. Doesn't every country need to have access to the global financial plumbing of the global system? When the countries that own SWIFT threatened after Russia to annex, when Russia annexed the Crimea, they threatened to kick Russia out of SWIFT, which is the messaging platform by which payments are made. And the foreign ministry of Russia at the time said that they would consider that an act of war. And I had some sympathy for that point, right? So is there some architecture there globally that everybody does have a right to access? And Farley, before I get to you, I realize I'm not really done beating up on Tim's constituency. So I want to go back to you one more time.
I've gotten used to it. So.
It's true that you are a little freaked out, I would say, by the enormity of the sanctions and the kind of the spotlight that this is getting and the role that that's been foisted upon you in terms of ground troops. But aren't you also, and when I say you, I mean the financial services sector, you are in fact making a cost-benefit decision about you. This is a business decision as well, right? And so
Sure. That's not unique to banking. Every entity makes cost-benefit decisions every single day about just making decisions about what markets to go into or stay into or exit and how they exit. So yes, a lot of this business, correspondent banking business, a low-margin business, it was a side business for corporate clients. There's a whole host of reasons, but this isn't just turning off one or two. This is getting out, Barclays, getting out of Africa. I mean, these are big, sweeping changes as many of these large global institutions retrench, become very local focused. Barclays or Lloyd's wants to be a UK retail institution. That's a very different footprint than what they have now. And as we're rewiring the global system, there's going to be enormous collateral damage, without question.
But my point is, aren't you blaming the regulatory environment for business that you don't want to do anyway?
Oh, that's an old hat. Look, it's a low-margin business because of regulatory changes. It makes it more expensive. Boardrooms are making decisions about what business to be in and not be in and understand the risks associated with it. It's a rational decision. So it's unfortunate for all the noble reasons we've discussed. And many of our institutions talk a lot about financial inclusion. It's not just a corporate social responsibility piece, but they are looking for ways to make it part of the business unit. But it's very, very hard if you're trying to do remittances into Somalia. The costs are enormous, and the benefits are very little.
Yeah, I mean, I think Somalia as ground zero in this because there is a lot of terrorist finance that goes through Somalia, but remittances are also well over 50% of GDP in that country. So, but Farley, how, from your perspective, are we going about this in the right way?
Yeah, I mean, I think, it's useful in the context of a discussion on the unintended consequences of de-risking to talk about how are we doing with the intended effects, right? How are we doing in terms of detecting and preventing the estimated 2 to 6 trillion US dollars that are laundered through the global financial system every year? Those are estimates from the IMF and the World Bank. That number can get even higher depending on how strictly you sort of define, strictly or loosely you define money laundering. The UN estimates that we detect and prevent less than 1% of global illicit financial flows. Raymond Baker, who runs an organization called Global Financial Integrity in DC, used Treasury data and came up with a number that was about 0.1%. And then even in the US, if you think, where we sort of indisputably have the best resourced and the most aggressive anti-financial crime infrastructure, the US government's principal body for seizing illicit money, the proceeds of crime, seized about 1.5 billion in 2015. And if you do the math, that's about between 1/4 and 3/4 of 1/10 of 1% of that global total. There's some debate about those numbers, but I think the bottom line is that despite the aggressive government efforts, the increasingly aggressive government efforts that we've been discussing, and despite the massive expenditures on compliance that industry is making in response, we're really not that good at this. And we're really not doing a lot to achieve those intended effects. And I think this can be traced back to a lot of different problems in the sort of the architecture of the whole thing, but one of the fundamental issues that I think that I see and that I'll kind of close on is that there is this unresolved question of what is industry's role and responsibility in helping the government or governments around the world in what is fundamentally a law enforcement effort, right? Are the banks an ally, or are they sort of an adversary? Are they facilitating, this condition that we're in? My opinion on this is that government has already admitted that they can't do this without the banks, right? The Bank Secrecy Act, the Patriot Act would not be written in the way that they are, in which they functionally serve to deputize the financial industry to be part of this fight, if government could do this alone. And so that leads to sort of a question of, well then, why is it that the costs of screwing up are so high that banks are forced to spend so much money on compliance, which protects them from the government, not from necessarily, it does not necessarily stop bad guys and stop financial crime, as I've just sort of laid out, or it's a very different thing anyway. So they spend all this money on compliance to protect them from the government, when in fact, the banks and the government should be working together to stop bad guys. And that's the system that we need to pivot towards. I think there's sort of a policy, a regulatory policy issue that needs to be solved there, about how we engineer a pivot from compliance to stopping bad guys.
Matt, let me let you respond to that, but let me also ask you to start off, to what extent did the Treasury Department anticipate this state of affairs that we're in now when you were first?
Well, I think first it's a natural and a healthy tension between the two different sides of, say, policy making at the Treasury Department and other agencies of the government. On the one hand, those policymakers who are responsible for global growth and development, which includes financial inclusion. And on the other hand, policymakers and regulators that are responsible for stopping illicit activity or actually addressing the national security threat, which would be terrorism financing or drug trafficking or whatnot. I don't think it's anyone's position that the bank should be open ground for illicit actors to conduct their activity because it's not the bank's responsibility, or we can't do it well, or everyone wants to see it. I think everyone agrees at the end of the day that the goal is to find the right balance between making the banking sector an unfriendly place for illicit actors, while at the same time not putting undue negative effects on the greater global economy. I think the policy community, the government, has tried to derive two sources of value from the banking sector. One is imposing a cost or a tax on illicit actors. On the other hand, it's a rich source of information, but that comes with both benefits and burdens. So banks are required to file SARs, suspicious activity reports, with respect to activity that they see in their bank. The filing of SARs has become a very controversial aspect of regulatory compliance, as well as the value of SARs, I think, has become increasingly questionable when an extraordinary amount of activity is being filed as as suspicious activity. So I think finding that proper balance is something that everyone needs to move towards, and in particular looking at the cost side of the equation. When the costs of complying with regulations become higher than the revenue derived from providing that business, then the outcome is very clear. These are businesses, and the businesses will exit, despite protestations that may come from governments, including the UK government, which has become so concerned that they've started making statements saying that banks will not be able to exit relationships if they don't have documented reasons for exiting the relationship that are conduct-based. But what does that actually mean at the end of the day? Is there going to be a blanket indemnity for each relationship that is not de-risked?
Right.
These are questions that I think the industry is going to continue to have to grapple with.
Yeah. And I think the point that you're making, that balance of needing to see flows for intelligence versus not wanting those flows to go through the system, and also the cost-benefit analysis that comes with regulation, are both very interesting points that I would like to pursue with you further. But I want to focus on Farley's question with you, and I appreciate that you're not a regulator, but you're wearing the hat of the policy, and this idea that now banks they're concerned about how many audit cases they've filed, and have they filed in a timely manner, and they're just so busy trying to comply with the compliance regime that they're focused on that rather than actually focused on the illicit flows themselves. And how do you help us think through that? They're filing so many SARs, for example, for that reason, right?
So I guess one question to ask there is, how well positioned are banks as the right entity to identify the illicit flows? And on the one hand, it could be derived from knowing your customer. So banks have an obligation to know who their customer is, whether that customer is an individual, a business, or another financial institution, and then to have expectations as to what the banking activity of that customer should look like, and if it's unusual. I think there's been a lot of progress made from the technology standpoint with respect to identifying suspicious behavior, potentially, with respect to their customer base. On the other side, there's actual intelligence-based identification of bad actors. And I would argue that in some cases, financial institutions can use open source information in order to help identify what would be high-risk customers and how high risk, where they stand on that chain, and then decide based on the level of risk, do we want to engage in this business, and then how are we going to put a framework in place in order to monitor that activity. That's the open source side. On the other side is the government, and the information that's available to the government through their resources that identify bad activity. And the government has a number of ways to communicate that information to the public, whether it's sanctions lists or other information that comes out through the Department of Justice and court trials and so forth, or other enforcement actions from customs and so forth. And so, the goal here is to try to bring all sides together, information that comes out of the government, information that exists in the open source along with what comes out of the government, and then putting in place a properly resourced program at a financial institution that can leverage that information and also understand the patterns of activities from their customers. But you've got to get the cost side right, because if it becomes too expensive, then the banks just dump all of the business wholesale without looking at risk.
Yeah, John, I feel like you're quite squeezed in the middle, actually, because
I'm biting my tongue. It's practically bleeding right
now.
Right. Okay.
Because you are customer facing
Yes.
for people that need to put remittances, but you also worry about your own access to the banking. You're not a dollar
Sure.
clearer, right?
That's right.
Western
Yes.
Union. So you have your own access to the banking system issues. So.
Well, look, there are many comments I can make about this. You're right. We need to have access to banks and bank accounts. Our agents need to have access to banks and banks accounts. Remittance industry, basically, and in this case I'm speaking on behalf of the industry, not on behalf of Western Union, basically settles all accounts daily. So there's no open positions, there's no credit, there's nothing. So when we see these de-risking decisions being made, it doesn't shut down our business in 6 months or 3 months or 3 days. It shuts it down the next day. So we and others, including our agents, need access to the banking system. And I think I was interested in hearing some of these comments here because I do a lot of regulatory outreach. I go around the world because we are in 200 countries to talk to regulators about how we can fix and solve problems like this. And I think one thing that I often say is, look, our goals should be the same. We should have exactly the same desired goal here. And the issue is we're very inefficient right now because we're thinking about getting bad money out of our system. We should be thinking about getting bad money out of the system. So each of us, each institution spends millions and millions of dollars to do AML for their company. We should be doing AML for a broader audience, and it'd be much more efficient, much more effective. And I think there's a role for the government to play in helping and assisting and sharing that information. But you're absolutely right. We have a need for banking services to fulfill the needs of our customers on a daily basis. And if we lose that access, it's gone, and it will go forever. And as I said, the money will still flow. It just won't flow through the formal channels.
Christine, how's your tongue? Is it also bleeding, or are you?
Yeah, a little bit. Interesting points. I think one of the key points that was made is that what's happening is if we're creating an unbanked situation and people that don't have bank accounts, they are actually still moving money. Yeah. And that's money we're not monitoring. And it may be terrorist financing, it may be money laundering, it may just be legitimate movements of money. But I think we need to make a decision as regulators, as policymakers, as countries, and as banks really, about whether or not we want to continue to be engaged in de-risking and run the risk that money is not going to be able to be monitored by law enforcement, and we're actually going to make ourselves potentially more at risk as a society and as a banking services sector. So I think that's a really important dialogue that hasn't happened yet, and I think the more we can encourage banks to not de-risk, to perhaps take a different approach, to look at ways they can find, keeping companies or keeping individuals in the system in a way that is more risk compliant, I suppose, then I think the more we're not going to have a financial inclusion problem, the more we can monitor the flows of funds. And I think we want to get to that point where we keep the money in the financial system. It's transparent, but we're not creating a situation where we're unbanking people.
I think that's a great segue into the solutions part of the panel, but I want to give Tim one more chance at the whining to respond to some of this, because you are spending so much money on compliance now.
Right.
So, yeah.
It's true. The hottest job in New York is a compliance officer. If anyone's looking for a new career, it's a great place to go because everyone's poaching from everyone else. The data sharing, data privacy issue is huge, and we'll talk about that as soon as when we get to solutions, because technology can help with that. I just had a board meeting in January, 40 institutions, chairman, CEOs, the biggest banks around the world, and insurance companies. We spent our entire board meeting talking about data localization, data privacy. It's all about how do you share information within an institution, let alone with other institutions, law enforcement authorities, and do that across a whole host of jurisdictions, especially in places like Europe, where privacy restrictions are pretty severe. Two is, someone mentioned there's a whole host of regulations. This isn't just about AML restrictions. For example, the Basel Committee of Bank Supervisors are looking to reform the way in which banks calculate operational risk. Up until now, they used individual models, and you as a firm would model your op risk based on your previous history. We're now going to move to a standardized approach, which means you're simply taking the transgression of all institutions, averaging it, and forcing the good institutions to pay for the sins of a couple of bad actors. So just the cost of op risk, of operating, and your capital charges are going up. So it's not just this piece or this piece, it's the panoply of regulations and changes which are being put in place, which are making business in a lot of these locations very, very expensive. But why don't we stop there and we go to solutions? I'm tired of complaining.
Okay, all right, that sounds good. I did want to give you a little airtime on kind of the lack of regulatory clarity, though, that you face.
Well, we've asked for clarity, and to the credit of some of the regulators, Mark Carney, who's the governor of Bank of England, but wears the head of the FSB, is really trying to solve this problem. And kudos to Mark. We met in Lima at the Bank Fund meetings in October. We had a whole host of Caribbean and African central bank heads and finance ministers there, and you hear compelling stories of countries being shut off for a whole host of reasons, not just terrorist finance, but it's drugs and a whole host of other crimes. And I think Mark, through the FSB, is really trying to solve this. And the FATF crowd is trying to offer some definitions. But again, I go back to the boardroom. The boardroom says, do not take these large asymmetrical risks. The reward is minuscule, and it has potentially large either dollar or reputational risks. So they're simply not doing it. The clarifications, the definitions will help, maybe help at the margin. I think it's the right thing to do, but it's not a wholesale solution, certainly not in the near term.
You know, I was a banker at JP Morgan for 8 years, and the same thing that's happening, at the low level, at the working man level, is happening on both sides. So the OCC examiner, who's out actually examining banks, is very risk averse. There's no incentive whatsoever to allow any kind of tolerance for. And same thing with a junior banker. As a junior banker, has no incentive to run something up the chain. It's just not worth it to try to get this piece of business done.
Well, and you get conflicting signals. If we could just digress for one moment on the Iran sanctions deal. So as part of the nuclear agreement, the UN relaxed its sanctions. We see European countries relaxing their sanctions. US government officials, including State Department, are running around the world telling banks, we want you back in Iran. The fact is, there's a whole lot of sanctions, the US housed sanctions, which are still in place. And I know many institutions which went to their home regulator and said, the State Department was just here, they want us back in Iran, what do you think? And they said, you're crazy, we should never go back there, don't even think about it. So, here institutions are getting a variety of different officials coming through the front door saying, do this, don't do that. And it's confusing, but again, it goes back to, they're not going to do business there. It doesn't matter what Secretary Kerry says. The risks are too high for them to go back into Iran or any of these other countries.
Well, they're still blacklisted.
Absolutely.
And they're still blacklisted, so some of the financing for some of the great deals that have been announced will never occur.
They'll never occur.
Yeah, they'll never occur.
That's right.
Yeah.
Does anybody else feel absolutely compelled to say one more thing in the whining portion of the panel before we move on? Matt, do you want a chance to respond to anything?
I think the issue is much broader than Iran as well. I mean, there are sanctions programs that cover Syria, that cover Yemen, that cover countries in Latin America and Asia and so forth, Burma. Yemen is an interesting one. There are 3 or 4 designated individuals in Yemen under a UN and US sanctions program with respect to the current civil unrest there. But the Treasury Department has given guidance which says any groups or individuals tied to those 5 folks on the list should be considered off limits, which can be very difficult for a financial institution to understand. How do we implement that? How do we identify what is the full range of actors in Yemen that we should not be doing with beyond the 3 or 4 or 5 folks that are on a list? So when you multiply that issue across the globe, the uncertainty becomes very significant.
Okay.
And I will say one other thing on this, because in countries, Burma is a good example. We were encouraged to set up remittances in Burma, and for a good reason. Money going in at a grassroots level is far more effective in stabilizing a country and creating the types of institutions and progress that we want to see than sprinkling foreign aid across the top of the house for obvious reasons. So it's important from that perspective too.
Yeah. Okay, so let's move forward to solving this problem. Right. We have 31 minutes to do that, so I'm very excited about that. Just to be clear, solutions does not mean what we should have done. We are talking about going forward from here, what we think we can do to put in place a better framework or regime to help solve this problem. So Farley, what do you think we should do about the de-risking issue and AML?
Well, let me first just push back a little bit on the way that this has been framed. I don't think that this is necessarily an intractable problem. I think that of course, we're never going to catch and stop everything, right? But I do think that there's an awful lot of low-hanging fruit that we're leaving on the table right now. And so if the sort of the first irony of this de-risking debate is that we're not very good at de-risking those who actually need to be de-risked, then I think that the second irony is that we already know who many, if not most, of the actors in the world who are the truly bad. We already know who a lot of them are. There aren't millions and millions and millions of these people and companies around the world who are cartel members or weapons traffickers, proliferators, sanctions evaders. If you look at the US Treasury's OFAC blacklist, it's between, I think, 5,000 and 6,000 at any given time. As Matt rightly points out, there is some ambiguity there about how the related parties to those entries and how big that thing can actually get. But then if let's say you double that to include related parties, let's say you double it again to include other control lists and Department of Justice targets of major money launderers or cartel members, whoever. And then just sort of double it again for fun, and you're maybe in the high 10,000s, right? Maybe the low 100,000s of truly impactfully bad entities around the world. And of course, this is not the corner drug dealers or the sort of small fry stuff here. It was like I said, we're never going to stop everything. We're particularly never going to stop everything working through the banks. Some of this is not a sort of a banking issue. But these guys don't just go away, right? They don't just go away when they get sanctioned, when they get put on a list, or when they get named in the media, or in an indictment. They evolve, they change, they rename their companies, they reflag their vessels, they bring in proxy directors and shareholders, and they restructure the shareholding to get under the beneficial ownership thresholds that OFAC has put in place in a dynamic way. And we're really not doing a whole lot to figure out what that looks like, right? We're dedicating all these enormous resources to knowing our customers and knowing the haystack, but we're not actually dedicating a lot of resources to performing those same types of analyses on who we already know we don't want to find. I think that there's to build on this point of information sharing, there's no one bank or even one government agency that's going to be able to do this, comprehensively against everyone everywhere in the world that we need to care about. But if there was a way that we could, confidently share information and resources and data within institutions and between institutions and the government, then I think that this is a very solvable, very tractable problem. I am certain that there are already more sanctions compliance officers in the city of New York than there are people on the sanctions lists, like unquestionably, right? We have the resources to do this if we can more efficiently allocate them.
Okay, so let's dig down a little. What are you doing at Sayari? Why do you think you have a solution there? What are you doing?
Well, again, and again, to Matt's point about open source and the wealth of data that is out there to be exploited, if anyone would care to look, we start with what we know we don't want to find. Whether that's on a regulatory blacklist, whether it's a major indictment or whatever, and work backwards. Perform due diligence on the people that you know you don't want to find. Figure out who are their associates, what other companies are they involved in, what else do they own, what else do they control, and map and change that over time, and look at how those networks evolve in response to the types of law enforcement interventions or regulatory interventions that that define this system, with the goal being, if you can identify the truly bad and the comparatively minuscule amount of people and companies around the world that are truly bad, and you can de-risk those surgically, then we can move from a system of this broad brush, sort of blunt de-risking, which is due in large part to, I think, a lack of granular information and intelligence on what we actually need to care about in many of these high risk and opaque and difficult to operate jurisdictions. That's what's going to move the needle.
But what I imagine is there are all these different databases, and all this information is not just sort of nicely there for you to try.
No, of course not. But look, I mean, if some of this data is online. You can the scraping technology and search technology, information retrieval technology has made leaps and bounds, over the past few years, and it's not. These are not. At this point, these are engineering problems. They're not, and they're optimization problems. They're not things that are.
Okay, Matt, you created this problem. What are you going to do?
Well, I think Farley makes some very interesting points, and I would create potentially one distinction. There's sanctions compliance and there's anti-money laundering regulations, and the amount of resources applied to sanctions compliance is much, much, much smaller than anti-money laundering. That being said, I think the opportunity for specialty information providers to help financial institutions do better at identifying the bad is a clear opportunity, and there will be multiple entrants into that market across a variety of different specialty issues. That will be, I believe, a net good in terms of helping banks do better to keep the bad out. Will that address the de-risking issue? I don't think so. The de-risking issue, at the heart of it, is there's two factors at play. One is know your customer. In particular, when your customer is a financial institution. So you're providing correspondent banking services to a bank in the Middle East or in Colombia or in China or Hong Kong. Now, what is your obligation with respect to that financial institution that's your customer? Do you have to know your customer, or do you have to know your customer's customer? And which means who are they banking? Mm-hmm. If you just have to know your customer, which is the financial institution, what do you have to know about them? Do you just have to look at ownership and management? Do you have to look at their control environment? Do you have to perform an audit on their control environment? Mm-hmm. How comfortable do you have to be with that financial institution that you're providing banking services to? And if they're then a regional service provider for another 20 or 40 banks, do you have to know those financial institutions that they're servicing? This is where a lot of the pressure is coming through. When your customer is a financial institution and you have to make a decision on what is the amount of resources that I'm going to invest to understand this customer from a KYC perspective, ownership management, the lines of business, the customers that they service, and then the types of activity that's coming through. And then how far beyond that do I have to go? Even the first level is creating enormous pressure from a cost perspective. In terms of solutions moving forward, what has to be addressed is the cost side of the equation. So one, to reduce costs, is there duplication of efforts across the system? And can we remove the duplication of efforts across the system? If you have multiple money center banks, clearing banks in the US performing the same due diligence exercise on a regional financial institution in Africa or in Asia, can that be simplified? Can it be outsourced? Can there be cost savings extracted out of the duplication of efforts? And secondly, do we need to look at the potential for cost redistribution Who should bear the cost of doing the due diligence exercise, even if duplication of efforts is taken out? Should it be the financial institution in New York that's not making much money off the relationship? Or can potentially some of those costs be shifted towards the financial institution and emerging market that critically relies on that relationship in order to exist?
Let me let you also give a plug for CompStall. How do you help your clients navigate this, and what do you?
So what we've been looking at is tools that are being developed, and developing tools are utilities that can address the efficiency side and the cost side of the equation in trying to understand risk that exists in correspondent banking relationships and portfolios of relationships. SWIFT recently developed a tool in close coordination with the banks that make up their organization, putting together what they call compliance analytics, which is sort of a one-stop portal allowing a financial institution to look at all their SWIFT traffic in the full message chain. This is, in our opinion, it's a step in the right direction. It potentially makes the system more efficient. It creates efficiencies for banks that are providing correspondent banking services, so that they don't have to invest more resources in understanding what am I exposed to, where is my risk coming from. But at the same time, compliance analytics, it has to be implemented properly. You have to be looking for the right types of activity. You have to understand what you're looking at. And to truly extract value from compliance analytics, you have to create efficiencies that can be utilized across multiple financial institutions. So everybody has to be singing from the same sheet of music to some degree. What are the standards? What is a financial institution that we're comfortable, as a bank, that we're comfortable providing services to? What if somebody else cuts off an institution? Should I then cut them off? Why were they cut off? What are the standards by which a financial institution should cut off? Should it be one set of standards, or should there be multiple standards? Is it okay for one bank to maintain a correspondent relationship while another drops it? I think the answer is potentially yes. There are certain banks that should probably be de-risked from the system. If you have ownership and management that is involved in illicit activity, if you have a bank that has been tied to illicit activity that's of concern and so forth, a bank that's consistently maybe evading sanctions, regulations, so forth, maybe those need to be de-risked from the system. But at the same time, there may be financial institutions in high-risk jurisdictions that don't need 15 correspondent accounts being monitored across 15 institutions, but one institution can provide that higher level of scrutiny to develop confidence and comfort in the relationship so that they're not going to be de-risked from the dollar.
But the government would never bless that, right? I mean, you'd never get that sort of seal of approval on.
I think that the concept of addressing duplication of efforts, if developed properly, I think it would importantly lead to no reduction in the efficacy of these programs. We're not talking about making the financial sector a more hospitable place for illicit actors. We're talking about holding the line on the efficacy of programs at a minimum, and then trying to develop efficiencies in the system where duplication of efforts can be reduced. I think if credible programs address that equation, then they should be welcomed by both sides of the House in the policy world of the Treasury plate and otherwise, those who are working on growth and financial inclusion and those who are working on combating national security threats.
Okay, John, what should we do?
So actually, the point on knowing your customer's customer is a very interesting topic. We process 31 transactions a second, 7 days a week, 24 hours a day, 365 days a year. So that task, the concept that a financial institution would have to know our customers is virtually impossible to solve. And the fact of the matter is it has absolutely no basis in FATF guidelines or in any statutory requirements. So I think what I would hope we could do, and we're working hard, and Treasury and others are helping us, is, as I said, this is very mundane, very boring, not particularly sexy, but issuing some type of joint guidance that makes it very clear what the expectations are and what the requirements are. And while some have done this already, and I think it's been helpful, a broad statement from FinCEN, Treasury, OCC, FDIC would be very helpful. And in some respects, that would help get this conversation down to the examination level, which is probably in some respects where some of the issues lie. I think examiners orally are probably who have a fair amount of latitude are probably advising banks to de-risk. And I think we need to have a very clear guidance, a very clear policy guidance. I'm not saying that some institutions shouldn't be de-risked, they absolutely should be. But I think there should be a distinction between those who are succeeding in doing proper AML compliance and those who are failing. And I think that will address this issue of not doing a wholesale de-risking. There are other solutions, obviously, that kind of run the spectrum. In Europe, you do have the right to have a bank account, which is probably a uniquely European solution that wouldn't work in the United States. But it is an interesting concept where the institution has to be able to prove that the entity who has the bank account doesn't have a proper program in place. One last solution that I've always kind of toyed with, I came from a banking background, because this is such an important segment, at least that our industry serves, with the underbanked and the unbanked and the financial inclusion. It would be great if we could get some concept of CRA credits for banks that bank this industry.
This is Community Reinvestment Act.
Community Reinvestment Act, and that I think would create some incentives actually for banks to do it, because you're absolutely right. The asymmetry, as I said, between the risk and the reward is so great. They probably need a little bit more to help them, encourage them to provide bank accounts. And then finally, I would say it would be great if there was some syncing up of regulation and enforcement. And I think that's partly some of the tension here, is that people are frankly confused. I have to operate a risk-based system. A risk-based system does not mean that you catch everybody. It means you catch substantially all. It's reasonably designed to prevent money laundering. That is the statutory standard. And I think that standard needs to be thought through in the enforcement side, because, as we said, the penalties, and we've seen some of these penalties for financial institutions, are very high, and the standard may not necessarily be that clear.
Okay, let me not push back necessarily, but let's explore just one more level this idea of clarity. The government has said very, very clearly, we are not going to tell you what good looks like.
Right.
We are not going to bless. This is not our role. And so, given that is kind of the lighthouse that is not going to move, what do you mean by clarity, actually?
Well, I think it's at least in the de-risking context, talking very specifically and very making sure it's very clear that we shouldn't de-risk entire industries, that people should be making a qualitative assessment of the AML programs that companies have, and if they feel in good faith that they have a good program, that should be good enough. So you're right, they're not going to give a seal of approval, they're not going to give a blank check, and I'm not looking for a blank check. We have responsibilities, and I want to fulfill those responsibilities in the AML space. But I don't want people to just out of hand dismiss my company because I'm associated with an industry where some players happen to have deficient AML programs. So I think it's just creating clarity around what is acceptable behavior and how to address and think about who you're banking and make some decisions about the risk that's associated with that.
Christine, solve the problem for us.
Yeah. An interesting thing about Iran, we were talking about Iran, that I think is little known, is when you open a bank account in Iran, talking about kind of consolidated databases, the Central Bank of Iran actually onboards you in part. So the bank onboards you, but they call the Central Bank of Iran. They make sure that you're not a debtor, that you're not a criminal, whatever it is they look at. And then if you're an unknown person, let's say, then they create an account number for you, and you become a Central Bank of Iran client at the same time that you become a banking client. And I think that that's really interesting in terms of onboarding and AML issues, because if all of the central banks looked at semi-onboarding people at the same time, theoretically central banks could talk to central banks on potential AML, terrorist financing, whatever it is, and more banks could be aligned in some way. So I think that model moves us closer towards, can we come to a point where we have some databases and some programs that are reliable, that are trustworthy, that are consistent at some maybe intergovernmental level or some level, so that we don't have all the duplication taking place in AML? And I think another really important change that we're coming in terms of looking at the vision is We talked about SWIFT, and they have this arrangement with, I think it's IBM Watson, where they're trying to look at ways that you can detect AML or fraudulent activity, and you can also onboard a client a lot quicker. And so if you use AI in the kind of compliance piece, I mean, sure, you know, BMO, for example, I think has 6,000 compliance people in downtown Toronto. Their jobs theoretically will be wiped out, a large part of them. So Wall Street, chunks of Wall Street will go, chunks of Bay Street will go. We know it's going to happen anyways with fintech. It's going to happen with AI. So I think if we can kind of consolidate those types of ideas and having AI pay a bigger piece, might be even more intelligent solutions in terms of compliance, and it would automate a lot of the processes, and I think it would allow us to actually merge some of the database results and some of these programs together. And so I think that's the wave of the future, and I think there's a role also for the fintechs to get involved, because I think if it's more automated and more machine-based and more tech, and we're all going to be having our bank accounts on our cell phones shortly, when the branches are gone, then I think that kind of, as well, if we can deal with now what the AML piece looks like to onboard on a cellular phone, to onboard on a fintech, then I think we're moving towards a more global solution and less duplication, less cost, and we have to deal with the risk piece as well.
So identity technology.
Yeah.
Tim, what would be most helpful from the banking sector?
Yeah, technology, to the points that just made, will help a lot, whether it's AI, or other technologies on the onboarding, authentication, verification, customer ID. And it doesn't all have to be high tech. I was just in India meeting with the RBI, and you know, they have this biometric identification system in India, which now has about 80% of the Indian population, about 900 million people with unique identification. They're also trying to solve some of the unbanked by giving licenses to new smaller payment banks, which are not leveraged and have a very different risk profile. So there are creative ways to solve the challenges that you're trying to address by also using and addressing the challenges our institutions are trying to address and use technology. The utility discussion that we've been having, you know, conceptually, I've been a part of this conversation now for about 2 years, lots of discussions in lots of rooms like this around the world about utility. It really comes down to data standardization, data sharing, data privacy, the ability to work across various jurisdictions, across various, even jurisdictions within a particular, or law enforcement and intelligence authorities within a jurisdiction. So conceptually, could it work? Sure. I think we're years away from having the legal apparatus in place that allows that information to be shared. But certainly, it's directionally correct. So utilities, and technology will help solve a lot of these problems. But I agree with, maybe it was Matt was talking about, we need to be much more focused. Right now, we're just throwing resources across the board when we really need to think about how do we get the guys in Brussels. I was just in Brussels. I go through Brussels airport frequently. I've stayed at a hotel close to the metro station that was bombed. How do we find those individuals? Because they crossed borders, they rented apartments, they made financial transactions. Why couldn't we find them ahead of time? And yet the number of suspicious activity reports that are being filed are hundreds of thousands. So it's more about focused efforts and aligning with law enforcement intelligence authorities to look for those individuals rather than trying to reinvent the world with all these various regulatory requirements.
You know, it occurs to me, and I want to, with the last 9 minutes that we have, open it up just one level, because it occurs to me that this is a model. You know, government actually can't do very many things without invoking private sector participation in the solution. So the fight against terrorist finance and money laundering is one example that we're talking about, but also in terms of cybersecurity and other issues. This has to be a cooperative approach between industry and government. And so as I give you kind of down the line the last word, maybe, and Tim, maybe I'll start on your end this time, how can we kind of think about these solutions and modalities for moving forward in a larger cooperative?
Well, there has to be trust between the official sector and the private sector. You need to find ways to provide safe harbor to private sector institutions. You need to make the general counsels of these institutions. We have lots of great conversations until the lawyers get involved and then it all is scuttled. Technology is key, but technology is expensive. And if you look at some of the large institutions, I was talking to a CEO just a few weeks ago, and I said, what's your biggest concern? He said, IT. So we've got systems that still run on COBOL processing language. Layers upon layers over decades of IT systems that need to be reinvented to deal with the new incumbents who want to provide you services on your mobile phone. While you're doing that, reinventing the customer experience for financial transactions, you're also trying to deal with all these back office issues of compliance and trying to find potential terrorists. So the technology costs are huge, and not every institution, especially smaller institutions, can afford that kind of cost. So it's about finding technology solutions, encouraging it. We do see in many jurisdictions the so-called technology sandboxes, which are encouraging small startups to provide some of these solutions, but it requires large institutions and a big balance sheet and the ability to scale and pay for the technology to ultimately provide sort of a seamless solution across jurisdictions.
Okay. Final comments.
Yeah, the sandbox model is an interesting one. Australia just announced they were going to do one, as well as London. So the idea is you would develop a fintech, for example, that might deal with AML solutions in a way where the regulations are suspended, and provided you weren't too exposed, the government would allow you to kind of grow your fintech business to then get connected to the larger financial system. So I think there's some really interesting financial technology companies that are addressing all of these issues on financial inclusion, on kind of solving the de-risking by actually allowing remittances to go through. But the one piece that they are missing is legal, for sure. There seems to be a big gap, and kind of like they get to a certain point and then they realize, oh, there's an AML law. So like I think one of the issues is from the beginning, when a lot of the new technology comes out and is beginning to be developed, and in fact people are investing in them, I think having the dialogue about being part of the financial services sector is complicated, is regulatory heavy, and sure there are some great solutions coming down the line, but you do in fact have to kind of be aware of that big piece, or the fintech will just die. But I think fintech is has great promise for financial inclusion, especially.
Okay.
Well, this may be pure fantasy, but I go back to my view, and I think I try to promote with regulators that deal with us the concept that we are trying to work for common solutions, because we are trying to achieve and accomplish the same thing. Obviously, that requires two-way trust. That requires trust between the government and the entity and the government. My sense, and I've been doing this for 30 years, is there's a great desire in the private sector to really do the right thing, to get bad people out of the system, to get bad money out of the system, to help the government in ways, of course, that are legal and respect privacy, but help the government. And I think if we get out of more of an enforcement mentality and more into a cooperative mentality, as I said, we will get bad money out of the entire system, not just out of one institution system. It's, as I said, it seems very idealistic, but as a lawyer, I guess sometimes I can be idealistic.
We're
and
idealistic at the Milken Institute,
right, exactly.
so
I would hope that we can do that, and I try to do it. And it's interesting that you get some traction. Sometimes there are others that actually will listen and do it, and hopefully that will continue to be the case.
Okay, fantastic. In the last couple of minutes, Matt.
I think on the issue of de-risking financial institutions, the situation I would ask is a bank in New York receives an application from a bank in Afghanistan to open a correspondent account. Okay. And that bank in New York has to then decide, am I going to provide correspondent banking services to this bank in Afghanistan, right? What should that process look like? And realistically, what is it going to cost for that bank in New York to make that determination based on that process? There needs to be agreement, standardization between both the regulators and then across the financial institutions as to what that process looks like on whether we're going to provide correspondent banking services to that bank in Afghanistan at the front end, and then what the monitoring looks like after that bank has been onboarded. And then if everyone agrees there and understands the costs, what is the most effective and efficient way to reduce the duplication of efforts and then to allocate those costs accordingly?
Right. Yeah, that would be a nice world to live in, for sure. Farley.
Well, I think that fundamentally what we need to do, as has been said, is engineer this pivot from an environment where we have government and banks and sometimes working at cross purposes, and banks focused on compliance to protect themselves from governments, to more of a collaborative environment that focuses on finding bad guys, right? And I think that the way to do this, I think a good first step for this would be we need some kind of a pilot program that puts banks and law enforcement in the same room to focus on stopping financial crime or finding bad guys. And I think that this is already underway in the UK. The Joint Money Laundering Initiative, the JMLIT that they call it there, is exactly that. Pre-cleared members of financial institutions sit with law enforcement and review cases, take information back to their institutions, put together financial intelligence reporting tailored for law enforcement requirements, bring new leads to law enforcement, and that's the way that is what they're exploring right now. That process is under review. I think and I hope that it will be extended and institutionalized. And I am dismayed that there is no real effort, at least that I'm aware of in this country, where so much of this pressure emanates to replicate that model. And I think that would be a very, very impactful first step.
Okay, so 2 minutes left, lightning round. Number one idea or priority for government? Start with Farley, go down the line, and then we wrap it up.
Put everyone in the same room and have them chase bad guys.
Matt?
Eliminate duplication of effort and increase efficiencies.
Clarity and joint statement from the regulators on what responsibilities the banks have.
Require banks to look at financial inclusion as part of their mandate.
I like all those ideas. I think the UK model is a great model, and we got to replicate it in other jurisdictions, absolutely.
Okay, thank you very much, panelists, and thank you so much for attending this session on Wednesday morning.